slide continues. Stocks on Wall Street fell for a second day, as global markets retreated and oil prices continued their record slide. An oil futures contract in the U.S. made a historic plunge, with West Texas Intermediate crude for May delivery falling below zero for the first time to settle at negative $37.63 per barrel. Monday's crash shows a stark picture of how demand has been obliterated by the coronavirus pandemic. While storage tanks in the U.S. have run out of space, companies are actually paying traders to take the oil off their hands. Cushing, Oklahoma, is a critical oil storage hub and delivery point for American oil traded on futures markets. WTI is already down a staggering 102% year-to-date, and Brent is down 65%. The U.S. energy sector is more than 50% below its 52-week closing high. The S&P 500 was down about 3% on Tuesday, adding to a nearly 2% drop on Monday, and pace for its biggest decline in 3 weeks. Major European markets were 3% to 4% lower after a similar decline in Asia. The two-day slump is yet another shift in sentiment for the stock market as it searches for a clear path forward during the coronavirus crisis. In recent weeks, the S&P 500 rose more than 25%, recovering roughly half its losses from a plunge in late February and early March. Investor spirits were lifted by a federal rescue package and promises by the government that it stood willing to pump trillions of dollars into the financial markets. Early signals that pace of growth in COVID-19 infections also buoyed the spirits of investors, suggesting the appearance of a dim light at the end of a tumultuous tunnel for the economy. But periodically fresh evidence of the scale of the downturn, minus 20 million jobs have disappeared in the United States in 4 weeks, has pierced the bubble and returned investors' focus to the sheer size of the recession. The red flags have come in the form of prominent forecasts about collapsing corporate earnings, or a contraction in GDP that would have been unthinkable before the outbreak. Goldman Sachs expects the economy to shrink at an annualized pace of 34% in the second quarter. This week, it came from the oil markets, as the price of one oil benchmark dipped below zero for the first time, meaning some holders were ready to pay people to take a barrel off their hands. Every so often, reality bites, said Steve Sosnick, chief strategist at Interactive Brokers in Greenwich, Connecticut. You could not ignore what was going on in the oil markets. The unnerving inversion in oil prices reflected an economy in freefall, disappearing demand for petroleum, and the fact that there are few places left to store all the crude still being pumped. On Tuesday, the sell-off in oil continued, with the most closely watched price for oil in the United States, for a futures contract stipulating delivery of West Texas Intermediate crude in June, was trading just under $11 a barrel, well away from the negative territory but still down about 45%. Brent crude, the global benchmark, dropped about 24% to $19 a barrel. As the smoke clears, that's the number one question of the markets today. Anyone who thinks that the technicals are behind the pricing yesterday is going to completely miss the point. Dave Ernsberger, global head of commodities pricing for S&P Global Platts. On Tuesday, President Trump said on Twitter that he was asking administration officials to formulate a plan that will make funds available to help the oil and gas industry. He has previously asked Congress for $3 billion to purchase oil for the Strategic Petroleum Reserve, but lawmakers did not include it in last month's $2.2 trillion stimulus package. Treasury bonds rallied, pushing yields, which move in the opposite direction, lower. The yield on the 10-year note hovered around 0.56% shortly before midday, suggesting investors were pricing in lower inflation and growth.